In 2 weeks, the follow-up reports detailed that it really was just these hedge funds that were covering those shorts. And when you cover a short position, you have to buy it back. You're buying, and that's what makes the price go up. So that's what happened. And now we're kind of in this kind of no man's land, kind of limbo area where maybe they'll come in and short some more. Maybe price will go higher and cause more short covering. That's typically how rallies begin. You start by getting short covering and flipping those positions, but we haven't quite crossed that bridge just yet. So we're kind of stuck here. I've been following the commitment of traders reports for about as long as I've been running TF Metals Report, which is a dozen years now. And I mean, the first thing people need to know is they're not a trading device, because the information is surveyed every Tuesday at the COMEX close. Some of the banks and other market participants in the past have been fined for submitting false information. So you got to take that into account. But if anything, the information that they do get is then it takes them 74 hours to process it and make it public. So all you can really use the COT, the Commitment of Traders reports, for is kind of, you have to have a historical basis. When you look at them, you got to go back and remember times when, the structure of the large speculators or the hedge funds and, versus the commercials and the banks, times in the past when the structure has been the same, and then compare that to where price is versus where the price was back then and try to draw some comparisons. And that's really the value of it. In kind of the bigger picture, you can look at it and say, well, okay, when there's speculative excess and price is getting ready to fall, it means that the speculators and the hedge funds are all long, and that all the entities that usually trade on the long side have gotten long. And at that point, you have potential for more sellers and buyers. And all that needs to happen is for price to tip over, and then things starts to, kind of cascade itself down, and you start getting some stops and, that sort of thing. And we recognize that. And we've seen that obviously for longer than I can remember. The opposite is also true, but people don't necessarily want to believe it, that at bottoms, those same speculators and hedge funds get short. And after a while, all that are going to get short have gotten short, which then leads you to have more buyers than sellers eventually. And price starts to go up and shorts get squeezed and covered and price goes up some more. That's exactly what we saw over the last 3-4 weeks, I guess. Silver dropped down to $18 one day. Intraday, we saw that the hedge fund category within those reports showed a position of something like 18,000 contracts net short, which for context, I mean, we've seen that as many as 60 or 80,000 contracts net long before. So when you get that short, which means then the issuing banks are long, you feel like you're pretty close to a bottom. And what happened is you got this surge off of that $18 level. Price rallied, 15% in 2 weeks. The follow-up reports detailed that it really was just these hedge funds that were covering those shorts. And when you cover a short position, you have to buy it back. You're buying, and that's what makes the price go up. So that's what happened. And now we're kind of in this kind of no man's land, kind of limbo area where maybe they'll come in and short some more. Maybe price will go higher and cause more short covering. That's typically how rallies begin. You start by getting short covering and flipping those positions, but we haven't quite crossed that bridge just yet. So we're kind of stuck here around $20. Well, this has been pretty aggravating for me and people at my site, because we saw this move coming out of late last year into the first part of this year. And I wrote about it in my annual forecast I write every January, and that, the Fed was going to go through these shenanigans and job owning to get interest rates higher to try to control inflation. And that would probably prompt a drop, to 1,800 in gold and below $20 in silver. And I thought, well, that would probably be the lows. And I thought that would happen maybe by May, June. And here we are now in August, and we're still at these levels. And that's the hard part, is where this is headed. I mean, eventually the Fed's got to start cutting again, and interest rates are going to go back down. It's the same games that they've been playing now since 2009. Problem is, it doesn't move at my pace, my preferred pace. I thought maybe the stock market would crash and that would prompt the Fed to pivot. Well, the stock market crashed, but it really didn't cause that pivot. And so things are just kind of moving along at a slower pace than I'd hoped. So eventually, yeah, the Fed will pivot and they'll start cutting again, and they'll have to do QE to monetize, all new debt and refunding that's coming. But until that actually happens, we're kind of go sideways. The period is analogous to late 2018 and the first half of 19, Elijah, where the Fed had spent about 4 years trying to jawbone quantitative tightening and interest rates. They got the 10-year up to 3.25, and then the stock market collapsed. And you got the Powell pivot in late December of 18. But the Fed didn't actually start cutting rates until June of 19. So in that period of 6 months, gold went up, and then it kind of grinded backwards. And then once the Fed started cutting in June of 19, it shot higher, about 25% in 90 days. That's kind of where we are again now. I think Powell, regardless of what anybody says, pivoted with his language at the last FOMC meeting 3 weeks ago when he said, we have moved in the past tense to a neutral rate. We have moved. That's what he said. So now we just wait, the 4, 5, 6 months, whatever it takes until the Fed actually pivots with policy. And so that's why we might continue to kind of just slowly grind higher for the next, several weeks or a couple of months. If you're short, 100 silver contracts at a price of $19, and you put those on back in early July, thinking it was going to go to 16 or whatever, and all of a sudden the price goes to 20, when you're underwater, what, $5,000 on 100 contracts, that's $500,000. I can even do that math on the fly. And eventually you're starting to get margin calls, and you're like, oh man, I can't lose any more in this position. And so you cover it. And so the higher price goes, the more of those existing shorts are now underwater, and it increases the pressure on those hedge funds to either put up more money as a margin call or just cover them, just get out, just lick your wounds and move on. And that's generally where you get it. And it's just the opposite of when price comes down. You're piling in the longs because you're all excited because price is going to go higher. Price starts to break down. You put some stops under say it breaks below the 50-day moving average. Maybe you're going to put a stop below there, some other technical level, and the stop gets hit and price falls farther. And the same thing happens in a short squeeze, the upside, which is how we got 15% in 2 weeks. The key level now is pretty clear on the chart. The 50-day moving average is something that the front month September has fallen back below just this week. But also there's, that level up around where we're banging up against it last week around 2075 to 2080. If you can bounce and get back above the 50-day, probably maybe on dollar weakness later this week or next, and then you can start maybe making a higher high above 21. Because now think of it this way, Elijah, if you're a trader and you're short, or your hedge fund, you're short, and you're kind of, okay, maybe we're safe. Silver came back down 3% yesterday. Okay, where am I going to put a stop on this position, a buy stop, if price accelerates again? Well, you're going to look at the chart and you're going to go, well, let's see, last week it got up to 2080. Let's put in a buy stop at 21. If it breaks above 21, then we'll buy and we'll cover and get out of this, because it probably means it's going to 22. Well, then that's what we'll wait for next on the upside, is we'll think, okay, if price can get above 21, then you'll probably get like an air pocket where price goes from 21 to 21.25 in like 5 minutes. And so that's how that process works. So now we need to, if you want to rally and see some gains in the short term, then you need to get back above the 50-day and make a higher high than where we were Friday's close, to prompt more of this short cover.
It does seem like we're seeing, it's possible that we could be seeing like a not cooling off, but topping of inflation, right? Where we're starting then to see disinflation, because we did see the recent inflation number at 8.5% rather than the month before at 9.1%. Do you think that is going to impact the Fed's decision at all?
Well, I don't know. They're going to have to eventually pick one or the other. I mean, they could keep hiking away, and drive mortgage rates to 8% and all that kind of stuff, and further kill the economy. They've already inverted the yield curve by 30 or 40 basis points. We're already clearly in a recession, unless you want to change the definition of recession, like the political economists are trying to do. So they can do that and pushes, U.S. into a deep recession, or they can ease off and try to keep the markets afloat and everything, and the economy afloat too. I think that's the direction they'll go. But what do I know? I'm just this dope out here in the middle of nowhere that watches this stuff. I don't know, Elijah. It'll be interesting to see where the inflation numbers go from here. The drop, or again, inflation still 8.5%, higher than last year. The ease in the advancement of it was predictable just because crude oil had gone down from 125 to 95. And that's the biggest driver of everything is energy prices, and gasoline had fallen from $5 to $4. And so that was predictable. But now you look and it's like, well, okay, we're heading into the wintertime. U.S. natural gas prices are the highest they've been since 2008. Natural gas prices in Europe are just outrageous. I just read something this morning about how the cotton crop has been essentially destroyed by the heat and the drought in the southern plains this year. And so cotton prices are soaring, I should say. So we don't use cotton for anything. So don't worry about that. So I think it's kind of, I don't want to say naive, silly, maybe not fully thought out, this idea that suddenly we're going to go into deflation when there are still so many input costs that are soaring, and we still have all these dollars that are out there, that, whatever it is, 4 or 5 trillion in dollars that were created a couple of years ago. They're out there sloshing around, chasing too few goods. So inflation may ease back before going up again. I don't think there's any way the Fed will ever get the Fed funds rate up above the inflation rate. That I don't think they can ever get it that far before they have to pivot and reverse.
And it does seem like as long as that real inflation rate then does stay above or does stay negative, then that should be bullish for gold. It just seems kind of interesting how over the last 2 years, gold has pretty much gone sideways and silver down.
Well, and again, this just gets back to how it's priced, Elijah, and who trades all these derivative contracts that set the price. I mean, I just mentioned, it's almost all markets are run by computers now, not just the futures markets. I mean, the stock market is 80% HFT computer. That's how you're able to get, however many billions of shares are traded every day, because these HFTs trade stock positions back and forth, trying to nick each other for fractions of a penny. Well, the same thing is true in the futures markets. You got these machines that are pre-programmed to either buy or sell gold futures or silver futures based off primarily movements in the dollar intraday and movements in the bond market intraday. Well, they're also watching real interest rates. And here's the fallacy of that. I mean, real interest rates are the 95% correlated to gold prices, not just inflation, but inflation adjusted interest rates. Well, problem with that is you and I, thinking rational human beings, we would sit back and equate or come up with a real interest rate using today's numbers. We'd go, okay, 10-year treasury, let's say, is 3%. Current CPI is 8.5%. And we go, okay, well, at least at the time of me purchasing this 10-year treasury note, I'm locking in a 5.5% loss of purchasing power this first year. And then I got to look forward to decide if this is a smart idea. And okay, well, what's my real rate going to be next year? Maybe -3, as inflation comes down a little. How positive do real rates have to get over the life of that 10-year investment to actually get it back to zero? I mean, I'm going to have some pretty positive real rates in years 7, 8, 9, and 10 to get back to where at least I broke even, right? That's how you and I would look at it. But the machines don't have time to do that. They just look at the 10-year inflation expectations as of this moment, which is like, God, they can't even tell you what the weather's going to be a week from now. Every economists are notoriously incorrect with not only their economic forecast, but their inflation rate forecast. Look at the Fed inflation rate forecast for the last 10 years. They're horrible. But yet we're supposed to believe, right, that the 10-year break-evens, as they call it, because believe it or not, there are markets that trade on inflation expectations. We're supposed to believe that that inflation expectation 10 years out is accurate. And so these computers are programmed to buy and sell futures contracts based on the difference between the current nominal rate of the 10-year note and the current 10-year inflation expectation, which is like 2.6% on some of these measures. So they actually, computers look at it as saying it's a plus 0.2. When you and I look at it in real time and go, no, it's negative 5.5. But it's that fallacy. It's a part of how the computers are programmed. It's also due to how we price these things, price gold, that creates this illusion that somehow gold is no longer an inflation hedge. I suspect it is, and that $1,800 gold is quite the bargain in the grand scheme of things. But everybody else just wants to look at it through this lens, this prism of how the markets trade, and write it off as being, gold doesn't work anymore. Well, we'll see. Give it time.